Good morning, it's Sarah Harding and Anthony Landahl. So this morning we're just going to be discussing some of the impacts to consumers and small business after the Royal Commission recommendations which were released recently. So obviously I'm a financial advisor with clients. I currently am exiting hello Ben, a larger institution and aligning with an independent advice business. And Anthony here is a mortgage broker. So firstly, I just wanted to get started by saying that everything we're going to discuss today, it's just going to be a bit of a discussion. It's only general in nature and nothing that we actually say should be based on your personal circumstances. So if anyone actually needs to seek advice based on where they're at, that is a very different discussion. So if anyone else has questions as well throughout this discussion, please feel free to write them down and we'll address them as we go. So I guess firstly, I just wanted to get started by saying that it was very interesting what came out in the Royal Commission report a couple of days ago. There were 76 recommendations into the financial services industry, which obviously will all have a very different impact. So I firstly wanted to get started by saying that I was somewhat disappointed with the scope of the Royal Commission on the financial services industry. So from my experience of working both in larger institutions and in smaller practices, what goes on in the industry is very, very different. So with some of these recommendations, it does feel like the Commissioner has tarred the whole industry with the same brush. And it's very evident from social media. So if you've been looking at people's posts and feedback that people have been giving, that the main winners of the Royal Commission are the larger institutions and the banks. So today we're going to be discussing what that actually means for small business and consumers and clients out there. I'll be talking a little bit about some of the recommendations within the financial advice sphere and superannuation as well, which is what we advise on. And Anthony here will be talking about some statistics when it comes to the mortgage broking industry and his views on the mortgage broking industry.
Yeah, look, good morning. I think it's worth saying that the fundamentals of the Royal Commission were well intended in terms of looking into misconduct in the banking sector and financial services. And the truth is, Commissioner Hayne actually savaged the banks throughout the commission and throughout the whole process. So I think it's fair to say that the Royal Commission was well intended. There's obviously some really poor behaviours that have gone on from the banks, and they were really drawn out from the Commissioner. And there were some really, good examples of cases where consumer interests just weren't being looked at. So I think what the feedback that tends to be coming through now is that the recommendations don't seem to reflect the intent of the actual Royal Commission, which was looking in at banking misconduct, and it doesn't seem to have actually addressed some of the issues that have been drawn out. It's actually some of the main impacts of the recommendations are to two industry sectors, which is around mortgage broking and financial advice. So I think it's worth making that point that the Commission was very well intended. Some of the behaviours that were drawn out were an absolute disgrace from the banking sector. However, some of the recommendations don't seem to reflect what was actually discussed by the Commission. It's like they've taken a feather duster to the banking industry, the banking sector. Their shares, funnily enough, went up by between 5 and 10% from CBA, Westpac, ANZ and the NAB once the report was released. So it was well intended. The Commissioner savaged the banks, but the recommendations don't seem to reflect what actually went on within those four walls. So that's just a general comment, I guess.
Exactly. Oh, exactly. My point as well is that the Commissioner, if you have a look at his long history and career, doesn't actually have a lot of experience himself in small business, which I think is a reflection of some of these recommendations that have come out, which I think is very much a shame, especially when there's so many advice practices and mortgage broking practices around Australia that are for small businesses. So to come out and, basically say that, fairly most of this behaviour was done at larger institutions and banks. Yes, don't get me wrong, there were some smaller practices that did come out to be doing the wrong thing as well. But to tar everyone with the same brush and to come out with recommendations based on what was going on at these larger organisations, I don't think is quite fair and equitable for the industry.
Yeah. Well, one of the big things they talked about was the conflict of interest within the larger organisations and vertical integration.
Which we were expecting that to obviously get addressed, with the worst case scenario being that would actually be dismantled, but looks like they haven't made the recommendation to do so, which means that larger institutions will still be able to basically sell their own product throughout their advice chain, meaning that those financial advisors that are tied to these organisations will be able to get away with recommending the product that is aligned,
which hasn't removed the inherent conflict.
Which was, is the advisor actually acting in the best interest of their client? Which, if there is that conflict there, it's very easy for the advisor to come back to that, especially if that's how they're getting remunerated. So yeah, a bit of a shame to see that that will still be allowed in the future.
Yeah. So, and that was one of the big ticket items that was the focus of, and Commissioner Haynes seemed to have grasped that issue, however, made no recommendations around that. He seems to have really focused in on almost like scapegoats, mortgage broking, low-lying targets, and financial advisors who are fundamentally, at the end of the day, small business owners. They're referral-based businesses. So all our business comes from client referrals in terms of the way we behave and the work we do for our clients. And there seems to be a big information and education gap with some of the understanding of the role of advisors and brokers in the lives of consumers and the outcomes we're producing for them.
Yeah, exactly.
And also the impact of the recommendations. I don't think Hayne, with respect, has actually grasped the impact of some of these recommendations, which I know we're going to talk about this morning.
Yeah, exactly. So I guess one of the changes that they're recommending is that advisors need to write to clients every 12 months and disclose what their services are, what their fees are. Now, we're currently doing that at the moment. Obviously, as an advisor, you have to do that every 12 months. But from a client perspective, clients only need to opt back in every 2 years. So they're now bringing that back to 12 months. So really, it's just going to be more compliance for advisors and more chasing of clients to make sure that they still want to proceed with the services and the advice, which actually distracts a lot of advisors from doing their job. Another change that they're thinking or recommending is the removal of grandfathered commissions. Now, this one's really tricky because there are businesses out there at the moment which are operating with grandfathered commission products. Now, I know my business that I'm currently exiting has some of those, and paperwork. Yeah, more paperwork, definitely. Compliance costs, staffing costs, all of that sort of stuff. So with grandfathering commissions, these are commissions within products which are still paying an advice fee to the advisor. There still are some practices out there that have these types of products inbuilt, meaning that there is an advisor attached to policies owned by clients. So I know in my instance, I've been receiving income. As an advisor, what you do is you contact those clients, or you try and contact them to the best of your ability, but you're always there so that when they've got questions, they'll come back to you and ask questions or update their address, or if they need advice, you're actually there. Removing grandfathering commissions would remove quite a bit of revenue from quite a few small businesses around Australia, which would mean, if businesses are reliant on that income to pay staff, it's going to mean that there are a lot of businesses out there that are just going to fire their staff. So if a Liberal government doesn't look at how that's actually implemented, they're actually going to be hurting small businesses in Australia. So I know I joined the Liberal Party thinking that it was the party of small business that actually helps promote it. But, the government really needs to take this into consideration, how they actually implement getting rid of grandfathering commissions. So I think you mentioned before that if Labor gets in, they're actually looking to
they want to bring that implementation forward by 12 months.
Yeah. So if you have a look around Australia, how many people would potentially lose jobs? And I'm talking about back office staff and people that actually assist with the paperwork. You're probably going to see a lot of people that will be actually losing employment. So funnily enough, I think the government should really consider how they actually go about addressing grandfathering, trailing commissions and removing them. In my opinion, I got an email overnight from some clients I've tried to contact 2 years ago that have come back to me now and want to start asking me about fees. So if an advisor's not touched in that instance, who's going to service the clients? No one. No one's really going to be interested in helping people with those types of policies that may not be able to, pay for advice. So that's why we've got grandfathering commissions, and that's why there are those sorts of fees in those products, because most of those clients can't afford advice, which the government probably hasn't looked at.
Yeah, sure. Which is an important consideration.
Yeah.
It's a mechanism for the advisor to get remunerated for the advice they've given.
Well, just to be a point of contact. So if that client isn't in a place where they can actually afford proper advice, because it is quite it's becoming more and more costly, the advisor is still incentivized to actually pick up the call and talk to the client and help the client. Like, other than that, if I'm not getting paid for something, why would an advisor help? So, I think consumers really need to understand that you can't get anything for free, especially not when it comes to, to business and advice. And I think one of the underlying tones here is that they're trying to make out that paying for advice is wrong, or paying for financial services is wrong from anyone. And I just, we're trying to run business here. We're trying to run small business. We're trying to grow like every other small business. So people just need to expect that their, advisors need to get paid in some way or another.
As long as those fees are disclosed and the client understands the services that are being offered for the fees being paid, and the customer is happy with those fees, then there are different mechanisms for payment.
Yeah.
Whether it's a pure fee for service, which a lot of businesses do.
Yeah. Whether
it's a ongoing payment for an insurance policy, or whether it's another mechanism off an investment portfolio or something like that.
Yeah, so another thing the government, or one of the recommendations, was to get rid of commissions within insurance products as well. So the idea of having a commission built into an insurance product is that if somebody goes to claim after 2 years, so let's say, for example, they've taken out a trauma policy and that person gets a heart attack and needs to claim, well, if there's no commission and if that client isn't paying an advice fee, then there's going to be nobody there to actually help them go through the claim process and actually work with the insurer to get the best outcome. So by removing that from the policy is not actually a better client outcome, especially for clients that can't afford to have an ongoing advice relationship with an advisor. I don't know if the government has actually looked at that point and whether or not that came into the scope of their work, which probably didn't. But there are going to be people out there that obviously suffer as a result, and it's usually people that obviously can't afford the cost or the rising cost of financial advice.
Yeah, sure. And they're important points. So from the broking perspective, when Josh Frydenberg came out on earlier this week at about 4:30 in the afternoon, the first point he went into was talking about how brokers are remunerated. So I just want to start with, there was a recent report where Momentum Media went to consumers and did a survey, and what they found was, and this is really important because what's been proposed here will change the nature of how first home buyers and investors are able to source loan facilities and source mortgages. And I don't think that that's been fully understood by the Commissioner or either of the political parties. And I think that there's a big groundswell of, hey, hold on, have we thought this through, going on at the moment on social media? But fundamentally, 60% of consumers now use a mortgage broker to source their loan. 96% of these consumers are either satisfied or very, very satisfied with the role the brokers played. 63% who went direct to a bank said they would use a mortgage broker next time, which is quite a compelling statistic when you look at the recommendations that we'll talk about in a minute. And 80% of borrowers had no issue with mortgage broker remuneration structures.
Yeah.
Because at the moment, the way brokers are remunerated is we're paid through the provider, through the bank, through the lender we use for setting up the facility for the client. So there's no cost to the consumer to use a mortgage broker right now.
Yeah.
That structure has two components. It's got an upfront structure, and over time what they did was they amortized some of that upfront into what's called an ongoing repayment, or a trail commission they call it.
Yeah.
But fundamentally at the moment, consumers don't have to pay for our services. They're paid through the banks.
And now Rose has just said, can you elaborate how it's going to make it difficult to source home loans?
Yeah, okay, so that's a good question. So just I'll come to that in a second, Rose. So there were 4 main recommendations around finance, which will come to this point in a minute. There was around best interest duties, which is an extension of what's happening. They talked about restructuring trail commission and banning that, and so on new loans, so it becomes part of upfront commission. So the idea will be our repayments will be higher when the loan's settled, and that's a change in business model. The main change that will impact consumers is that instead of banks or the provider that we access for the client paying for the loan for the client, consumers, the recommendation was that consumers pay brokers direct. So if I go and source a facility for someone for $500,000 or $800,000, instead of the bank paying me my fee, I'll be going direct to the consumer saying, this will cost you $3,000, this will cost you $5,000, this will cost you $10,000 for my services to access the best loan, to build the right structure, to give you the credit advice. The issue with that is that part of that report said 58% of consumers are not willing to pay a broker fee. 11% said they wouldn't be willing to pay more than $1,000. So what it's going to do is consumers are effectively saying they're comfortable with the current structure where we're paid directly by the provider as distinct from them paying us directly for our services. So if I've got a complex case that I work on,
bad for consumers, upfront fees. Yeah, because no one wants to pay.
The point is that from a consumer perspective, so that this is why the bank share prices went up the day after it was released, and 2 of the big mortgage houses, Mortgage Choice and AFG, their share prices went down between 20 and 30% because this will decimate the broking industry because consumers aren't willing to pay those type of fees. I'll spend weeks working out credit advice, finding the right provider, provisioning that advice through to the client, and my fees would be $5,000, $10,000, $15,000 sometimes for the type of work we're doing. Now, consumers won't be able to access that if they're paying me directly.
Exactly, and I'll just comment on that. Coming from a banking background, most of the time, the skill of the mortgage broker at the bank versus the skill of somebody like yourself is very different. So if consumers are pushed to going back into banks to source home loans, I think if they don't really know what they're doing and the person providing the loan really doesn't know what they're doing based on the banking policy, it's going to be much harder for consumers to actually get funding and loans, especially if they've got fairly complex structures with trusts and SMSFs and all of that sort of stuff. So I don't see it as a really great outcome. It's going to get rid of that competition because consumers will just go directly to banks, so they're not going to be able to see what's best in the marketplace. And if talking about going online to have a look at rates, most of the time, depending on the situation of what you're trying to achieve, a rate is somewhat relevant, but not the whole picture.
90% of our work's around structure.
Exactly.
Getting the right structure in place. There's just a question from Jordan. Let me answer this, mate. Will the abolition of trailing commissions favour the big 4 banks? Okay, so that's a different issue, right? So
yes,
we get an upfront at the moment, and they're talking about the abolition of trail. Now, it depends how they restructure that, right? Because trail originally was part of the upfront commission, and what they did was amortise that over the life of the loan. What we're looking at potentially now is that if they abolish the trail commission, which again has been misunderstood by the commissioner, but that's a different issue. If they abolish that trail commission, what they'll do is they'll increase the upfront, and then brokers will just have to change how they run their business and amortise that over time. Or in fact, it might still be paid over time based on retention and product. So I don't think, while that may have some impact on some broking models, it won't have the same impact to drive consumers to the big 4 banks as going to a consumer pay model where the consumer has to pay a mortgage broker for their services. There's a lot of mortgage broking practices that won't survive. How is a first home buyer who can hardly afford a deposit going to pay a mortgage broker $5,000 to use their service? Or people with complex structures pay $15,000 or $20,000 to get the right outcomes.
Especially if they have to go to a financial advisor as well to have a look at what are your goals, where are you tracking, what's your overall financial picture. So who's going to want to pay $5,000 to $10,000 for an advisor, then go and pay additional funds from a mortgage broker if that becomes part of the strategy?
I think part of the issue is if it goes to consumer pays, there's a lot of there's two issues. It's going to drive a lot of people into the big four banks, no doubt about it. And the banks are absolutely happy.
Yeah,
with
that's why the share price went up.
Number two, there's a lot of providers out there, very good providers, who use brokers as their channel. They don't have branches. They'll be gone. There'll be less choice for consumers because they won't survive. They'll need to open 100, 200 branches to actually reflect the work that brokers do. Again, the big four banks win, and it's going to affect home buyers and investors who aren't going to get the same service, choice, or advice by walking into a big four bank, because mortgage brokers won't be able to service them because it will decimate the broking industry,
and that's one
if it goes to that model.
Yeah, will mortgage brokers be phased out? Well, if these recommendations do get passed and do come through, potentially, yeah, it's going to change the whole face of consumers getting loans.
And the main one, just to reiterate, is around going to a consumer pays the broker direct, as distinct from us being paid through the providers. And I put it to people out there, and we've done this, is if I do a piece of work for a very complex structure that I might charge a fee of $15,000 or $20,000, is a consumer going to pay me that directly, or are they going to say, you know what, mate, I'm going to go to the bank? So there's going to be a lot of brokers who are going to be unable to survive and run a business if that is the model that's put through.
And I think from the advice space, so the way that I sort of see it in my business now, leaving a larger institution and going to a smaller independent, is that we're going to be less incentivized to help the mum and dad types of clients, the first homeowners, the people that are trying to get ahead and accumulate wealth versus people that already have substantial wealth, purely for the fact that, compliance has been driven up. So the cost of providing advice is going up, meaning that our overheads in our business are going up, making it much harder for us to provide advice to that, area of the community. So I sort of see that, the people that will be able to service that area of the community, being the mums and the dads, the people struggling to save the deposits, will be the larger institutions. So it's not a fair marketplace at all. It's only the rich will be able to afford the independent advisors that give holistic advice based on their situation and look at the overall market, versus the people that don't have a lot of money and are really struggling will be pushed back to these institutions. Like I said, when I used to work at these institutions, the skill level of most people that work there is usually, that's where you get started. I'll say that's where I got started. But as you grow and develop your business, your experiences, you work with different clients, that's when you start to sort of move away from those models. So, but for somebody to come and see an independent advisor, you're going to be paying a lot more. So it's higher entry costs because of the higher compliance costs that we now have to, potentially build into our business.
So fundamentally what's happened here, this was a Royal Commission into banking misconduct, and the recommendations have come out and are threatening finance broking and putting more regulation and red tape across advice. And the big threat to finance broking that we need to get that message out and consumers need to understand is that if you want to get a mortgage in the future and these recommendations are passed, if you want to use a mortgage broker, you will have to put your hand in a pocket and pay the broker direct for their services. And their services provide you with choice. There won't be as many lenders out there because they go through broker channels. We provide service, and we also provide credit advice. The banks want to corral. The banks would love mortgage brokers not to exist. We now take up 60% of the market. 96% of consumers are satisfied with brokers, and 63% of consumers who went through a direct bank last time said they'll use a mortgage broker next time. So it's really important that consumers understand what is being recommended here and what it will do to advice and finance broking. And finance brokers are 17,000 small businesses, like any small business, working hard every day, acting in their client's best interest, building their business on client referrals. So people need to understand the impact of some of these recommendations. And the Commissioner has taken a feather duster to the banks and come out with a steamroller across finance broking and financial advice, which are very easy targets.
Oh, exactly. So I guess one thing I do want to touch on as well is the fact that throughout the whole scope of the Royal Commission, industry super funds really weren't touched on that much. I think they were highlighted potentially throughout, but they really didn't get much spotlight at all. which I think is a little bit appalling. So as a financial advisor looking, out for my client's best interest, if we go to an industry super fund and we have a look at what the money is actually being invested in, you can't tell. Like, there's no transparency in the industry super fund sector. It has a number of different assets or the asset allocation, but there's no actual transparency around where that money is actually going and how that money is being disclosed. We've got these industry super funds coming out saying that, the performance is so much better than retail funds or any other funds. But to be able to say that, consumers really need to have a look at what that money is actually being invested in, and you just can't. So I think that one is a bit of an issue. The other issue is industry super funds should all be about members. So it should all be about spending for members. If that's the case, why do industry super funds promote at football games? Why do you see Host Plus on the back of, football jerseys and those sorts of things? Obviously, that's not for the best interest of members. That's in the best interest of potential members. So I think in that space, there was none of this sort of stuff that was touched upon, which I think was very unfair based on the fact that they did actually come out with a recommendation for everyone should have a default My Super account. So I just think that was that was a bit poor, not to touch on some of the issues in the industry super sector.
Are there any other questions on the way through? Put them in the screen. I think if we haven't answered the questions that have come through, let us know, but I think we've addressed most of them.
Cool. Is there anything else you wanted to talk about?
No, look, I think it's important to note that philosophically the Royal Commission had to happen. It revealed a lot of really poor behaviours in the banks and with management within the banks, and raised a lot of issues that there was an opportunity to address. And I think the main point we're trying to make here is that the recommendations don't seem to reflect the scope of work and the discussions that happened within the Commission. And that's what we're talking about. We're not questioning the Royal Commission or whether it was the validity of it. It obviously needed to happen. Commissioner Haynes savaged the banks in there, but he's hitting them with a feather duster in the recommendations and steamrolling small business fund at the end of the day, and mortgage brokers and advisors particularly. And that's what we've addressed today, I guess, is giving everyone a bit of an understanding around what that means for consumers as well as small business owners.
And I really hope that rather than just sort of endorsing all of the recommendations from the Royal Commission, the government actually does go out to, I guess, the industry and, consumers, and actually decide on whether or not some of these things really are necessary.
And one point really on that I want to make before we finish is the Liberal Party has indicated that the consumer pay model, they don't believe consumer pay model has been suggested by Hayne, but Treasury, ASIC, a number of bodies said that doesn't work. It's anti-competitive and it's not in the best interest of the consumer. The Liberal Party's come out and said they won't implement that. The Labor Party has come out and said they will implement that. So if the Labor Party gets in, that could decimate mortgage broking, because they're saying they will implement a consumer pays fee-for-service model. I don't think they understand what they're talking about with respect to the impact on consumers and small businesses. That's a slight difference between the two policies. The Liberal Party wouldn't implement consumer pays for our services. The Labor Party is saying they will, but I don't believe they understand the impact on consumers and small businesses.
Of course.
I just wanted to make that distinction before we finish.
Exactly. So, yes. So I guess that's all I really wanted to say as well. So if anyone else has any questions, feel free to post after this and we'll get back to you at a later stage. But thank you so much for listening to our discussion on, I guess, the Royal Commission report and some of the findings and what will come out of the, what impact that will actually have for consumers if some of these recommendations are actually passed and legislated.
Thank you.
Cool.